This is exciting times for a buyer.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Heidi Addo. Heidi, how are you doing today?
Doing well. Thanks, Todd.
And Heidi is with Michel Commercial. And Heidi, I wanted to bring you on because I wanted to talk about kind of what's going on in the market. Of course, you're based in Minnesota, you guys. Michel Commercial, for those of you who are listening, you don't know, Michel Commercial is more of a boutique firm. It's not your big like CBRE that's all over the entire country, but Michel Commercial is a big main player in the Twin Cities market and kind of outstate too a little bit, and a little bit maybe in Wisconsin and some of the surrounding states. But that's kind of where you guys are based. Break it down, Michel Commercial. Tell me a little bit, tell the audience, I guess, a little bit more of your background. You've been on the show, but your background and Michel Commercial.
Yeah, so boutique firm here based in the Twin Cities. But you're totally right. We do about 90% of our work here in the Twin Cities, but then in greater Minnesota, we are the largest multifamily player of $1 million plus in greater Minnesota. We do dabble in the other states. We're licensed in all the surrounding states in Minnesota, but focus on the Twin Cities, focus on Minnesota. Like you mentioned, boutique firm specialized in only multifamily. We really like to be the expert in our field, and we are. And been in business for 40 years. Not myself, but the firm. My dad's actually the president, so that's a great connection, of course.
Yeah, love it. And yeah, you guys are, I have really grown Michel Commercial. I mean, when I kind of was first starting to even look into multifamily, Michel Commercial was certainly there, and you guys were a big kind of a player in the market. But I would say, and correct me if I'm wrong, maybe I'm just wrong, but I would say the most of the listings were, under 100 units probably. And now you guys are seeing a lot of deals that are bigger deals. You still have those under 100 unit listings, but you are now listing a lot of kind of bigger assets and have been successful at selling those.
Yeah, definitely. Part of that is also our market. The Twin Cities has not been a national place where outside money has wanted to come in here. So there were trades going on, but it was very much private money. People would hold for 30 years. Well, now we have a lot more turnover in properties because there's national players involved, and the multifamily, market has changed a lot, where there's 5-7 year holds. It used to be 20-30 year holds. And you're right. In the last 5 years, we've improved. I mean, we've done a brand refresh. We've just become a lot more active in marketing, honestly, because the guys in our team were doing big deals for a long time, but it was a private market. It became a national market about 5+ years ago. And we upped our game in that way, just as people do. And it's helped us be really successful. Last year, 4 brokers did $418 million of multifamily deals in just Minnesota.
Wow.
So, I mean, it was a great year for all of us, and it was a great year in the market too. And we are actually, in this time, we are super busy. Todd, you and I talked beforehand, but as far as bringing properties to market, not super busy in listings. But the listings we do have, everyone's in flux right now. In our Twin Cities market, there are actually a ton of properties for sale. Most of them are not moving and not trading. And reason for that is clearly interest rates. Anything that's been brought to market in the last 4 months, even 10 months, interest rates have changed. So underwriting has changed. And then seller expectations are still pretty high. But we have underwritten 68 deals year to date. That's a ton of deals. That's a ton of sellers that came to us and said, hey, we want you to sell our property. Can you value it for us? And so to your audience, Todd, there's a lot of people that want to sell, recognizing this uncertainty in the market is making it challenging. We are taking an advisor role. If you don't need to sell, there are reasons to sell. If you don't need to sell, like your loan's not coming due, you've owned it for 30 years, you can own it for 2 more. Those kind of reasons. We're really advising, let's check back every 3, 6, 12 months. Let's revalue as your trailing 12 months improves every couple of months. Let's revalue, let's readjust. But we have been underwriting all year long, which really is another reason we hired a new broker starting in January. And the reason for that is our pipeline is packed. And I think that's also something interesting to note for people that are listening who aren't just in the Twin Cities. This is not just a Twin Cities phenomena. This is a national phenomena. An active broker in your market has likely a huge pipeline. And right now, I have 8 deals that I've been valuing just this week. And so that's a huge pipeline. And so, Todd, as a buyer, this is exciting times for a buyer, because a client I'm working with right now made a comment saying this is a buyer's market now. A buyer does not feel that. They do not think this is a buyer's market yet. But every deal that comes down, every comp that is now proving the new market benchmarks, it is shifting. Yeah. And I want to touch on in this conversation you shared with me, you want to touch on rent growth and wage growth. We can touch on that now or later, but those are major positives to multifamily and to our market.
Yeah, I want to just kind of talk, you pick on some of the stuff you've said. I mean, we're talking mainly Twin Cities, but like you already mentioned, this is happening kind of everywhere, or most markets across the country. And quite frankly, actually, the Twin Cities, it's Midwest, it's more stable. You're not seeing some of the factors that you're seeing in other markets like the, Phoenix and Austin and Atlanta, where you're seeing massive amounts of building and rents going down drastically. And, but, you mentioned 68 deals underwritten, and you guys are one of the brokers in the market. So it's not that there's only been 68 deals throughout all of the brokerage firms that are underwriting these deals. The Twin Cities is a market that just doesn't sell a lot of apartment buildings. Even though it's become more of a national market, as you mentioned, it still is one of those markets where people just don't sell their properties. So there's not a ton of trades happening. And I think, fairly active year just a couple of years ago might have been a 2019 number. So now it's aged quite a bit, but I believe that if my memory serves me right, I think it was like 21 properties that sold that year that were over 100 units, and that's it, right? So 68 deals underwritten is a lot of deals that you're looking at. Before we dive into the rents, I want to talk just about like who the actual sellers are that you're transacting with. Is it people that are desperate, that need to get out? Are you seeing that yet? Is it the guy, gal retiring, a estate sale? We've got a big, changing demographic, obviously, an aging demographic that owns probably a lot of the inventory, especially in like a market like the Twin Cities, I would think. So who are your sellers that are actually saying, hey, like, I'm going to sell no matter what?
Yeah, great question. So let me just kind of give an overview. Retirement, yes, what you're saying is true. Baby boomers are moving their wealth to the younger generations. That's been a trend that's, everyone's been talking about. It's going to happen. It's happening in our market right now and other markets. So baby boomers retiring. To note on the retirement piece, there has been a real challenge that has happened post-COVID. Residents are more vocal in how properties are managed and what they want. So some of these ma and pa owners that have done this for 30 years, the last 5 years have been the worst part of their career. And they're retiring.
And they're at the age where they don't want to make those changes either.
Yes. They don't want to make the changes. They don't want to deal with the headaches of the management.
Yeah.
And And then also, the operations of properties, the expenses have gone through the roof. So it's just become more challenging. The last 5 years have been a real challenge. So retirement, and then we get in some negative ones, and then we'll get to some positive ones too. But retirement, divorce, death, distress. When I say distress now, I'm talking about people who bought properties in the last 3 years, really high leveraged loans. They were banking on appreciation and rent growth. And some of these neighborhoods, Minneapolis, St. Paul, we've had rent control be in St. Paul. Well, that killed your pro forma. Rent control where you can't raise rents past a certain amount. And then in Minneapolis, we've had negative rent growth in some neighborhoods, not for the reasons that the South East has had, but just because people are moving to the suburbs, and there's perceived and sometimes in some neighborhoods, true increase in crime, and the safety is a concern in some neighborhoods of Minneapolis. Minneapolis is a dynamic city. It's going to come back, but right now there are some struggles in some neighborhoods. And
I think that's no secret. It's kind of been on the national news.
Yes.
So.
Yep. And so for those reasons, some of those people who bought when, for example, Uptown in the Twins in Minneapolis, Uptown is experiencing high vacancy, negative rent growth, crime on the streets. There's limited people walking around, so there's just more ability for things to happen there. And those renters finishing their leases, they're out of there. They just are. So they've got 10% vacancy across the board. People, if they're honest, probably higher. And every resident, they're just trying to keep them. They're not even trying to get new ones and get rent growth. No, they're just trying to hold on, or just get someone in there. So
probably a great example of a submarket that you could probably place a bet on. That with time, that submarket likely will bounce back. You can't guarantee anything, of course, but I think that's a submarket you could place a bet on and said, hey, it's going to bounce back. This has been a nice area. It will become better again, and it might take 3 to 5 years. But if you budget for that and you understand that and you get the right deal, especially from a seller that's just like, I'm just done. Like, I can't deal with this anymore. That could be that's a perfect example of the type of deals you want, right?
Yeah. And Todd, did you see that Widener out of Washington made a huge investment into Uptown and then also into our CBD business districts? Well, they're a good example. They often pay cash or very low. They they're lowly leveraged, like 50% LTV, something like that. So they're really coming in with a lot of equity. Their cash on cash is super low, but they don't sell for 10, 20 plus years. I think you're right. I think it's a great bet. And I think it's a great indicator that Minneapolis, that's the Twin Cities heart. And it's going to come back. 5 years, hopefully. 10 years, I think yes.
I think for sure. Yeah. Have you seen receivership, bank owned, that type of seller yet?
Not yet. I think people are getting in front of that a little bit. We've under deals that's coming in the next 12 months. Something kind of interesting to note that I've shared with other people is if you're in that position where your loan is coming due, there is a time, like if your loan is coming due in 6 to 12 months, some lenders are willing to blend your rate and extend your time period. And I've recommended that to other people, just trying to get us a little bit out of uncertainty. There's a hope that we could get a better price, but really the uncertainty is, the issue. And so my recommendation is always try to work with your lender to blend your rate, extend it. So if you had a 2% rate, now you're at 7.5, try to get in the middle there and extend it for 12 months. But I know that there are distressed sales coming to market. We haven't brought those to market yet, but they're coming because people are in that way. That's just the way the market is gonna, we've seen it nationally. Some big things in Texas happened. It's going to happen. That's how lenders, that's how people were underwriting deals super aggressively. The market changed with the most dramatic change since, the interest rates are even more dramatic than anything that has happened in the last 40 years, you know,
Yeah.
since 1980. So
Yeah. Right. Even that is even faster change than what happened, you know, way back then. So yeah, it's definitely a different market. And I don't think many people predicted it. You know, you had major, these lenders aren't stupid. They have the smartest people working for them, and they were doing deals. And these institutional buyers have very smart people, and they were doing deals. So it's not for the lack of brains that people were buying opportunities. It's that things changed. Literally, the rug was swept from people's feet. It's that black swan event that you talk about, but we're in it, right? We're in it. There's no hiding it. Say out of these deals that you've underwritten, most of them haven't hit the market. The ones that have, most of them haven't sold. The ones that sold, great, that's awesome. But what about these ones that aren't being listed, haven't sold? Is there a common theme? Is there a common reason? I mean, you've mentioned several things, but is there a common theme and reason why they're not selling?
Pricing and seller expectations. Seller expectations are.
So sellers, is it many times that sellers just don't care right now, or they just, is it that they can't sell because they would lose money, or is it that they're just like, yeah, whatever, if I can't get 20 million, I'm not going to sell it?
Yeah, the latter. Some people in a distress situation, they got to sell. And we haven't really seen a ton of that right now, but it's coming. But for most people, it's just like, nope, my pricing, I wanted this, it's this. And they see the, you know, perceived loss of value, potential loss of what they could have got a couple years ago. Now, if you can get now, well, that's a difference of $5 million on a 200 unit deal. Well, that's significant. Now, the hope is that you can get back to that. I think interest rates are not going to go to 3%. I hope they stabilize around 5-ish, you know, eventually, but that's not today. And the Fed has indicated higher for longer. I was more hopeful 12 months ago. I think that I think there's a lot of factors. I'm hopeful that it's going to stabilize, but I think higher for longer is accurate. We're probably looking at what we're seeing right now for 6 to 12 months, these interest rates.
Yeah. Yeah. I wouldn't disagree. Of course, what's probably accurate is that we're going to be wrong. You know, like I remember back in 2000, you know, whatever, 9, people are like, oh, interest rates have gone down so drastically, they're going to go back up. You know, and then 2011, interest rates are lower, and they're like, this can't stay sustained. They're going to go back up. And then all of a sudden 14 and 2016 and 2018 and 2020, it's like, wait a second now. Everybody's been telling us for so long that they're going to go up, but they didn't until they finally did. And now everybody's got an expert opinion on where they're going, but I think that's the biggest, maybe scariest thing for most people, is they don't know where they're going, and they're literally moving so quickly right now that it's like, okay, are they going to stay high? Are they going to get lower? Do I lock in debt right now? What kind of debt do I lock in? I know when we analyze a deal, we're like, well, we would prefer to lock in long-term fixed rate debt. But at the same time, is that really the smartest move? Because if you lock in long-term fixed rate debt and interest rates do go down to 5%, you're like, crap, now I'm stuck in this stupid loan, and it's big penalties to get out of it. And it's just like, so it's really challenging. But at the same time, if you don't lock that in, what happens if interest rates go up, right? So somebody, for instance, we bought a property in 2023, and we had this same conversation of, well, do we lock in fixed rate long term? Do we lock in shorter term with a rate cap, and knowing that rates are probably going to go down? Well, we locked in the fixed rate, 5.6%, I think, somewhere around there. Well, man, that would be an amazing loan right now. Yeah. Like, you'd be so thankful for that type of interest rate. You can't get it. So it quickly changed. That's just a matter of a few months, how quickly it can change. And that really is probably, that's a big disruption, right, to your business.
Oh, totally. Yeah. Anyone in the unless you're just holding properties right now, if you're an active player in the market, buyer, seller, broker, lender, developer, it's all disrupted.
Yeah. Heidi, look, we're active buyers. We want to buy right now. What advice would you give us and anybody listening to as a buyer, as an active buyer? Like, how do we? I mean, what do we do? What do we just wait? Do we what's your advice when you're talking to buyers?
Yeah, good question. And Todd, I think you may have said this at one of your events or someone on your team, but if you're active, you're always underwriting. When the market is hot, when the market is not, you're always underwriting and analyzing deals. I think that there's one thing that I would add that I wouldn't have needed to add last year. If you see a deal that you're interested in, call the broker and ask why the seller is selling. And if the broker is not straight with you, sniff around. If they're an opportunistic seller that's just wanting to see where the market is at, figure that out. Because if your time is valuable, which it is, there are some properties in our market that we underwrote and an opportunistic another person won the deal on opportunistic pricing. Well, that property did not trade. And that seller is frustrated because the pricing wasn't met. The buyers spent some time on it, made offers, did the whole thing, and then they decided not to sell. Well, that pricing was opportunistic in a market that is no longer really opportunistic pricing. So first, that's something new that I would say. Call the broker, figure out why the seller is selling, because if they're just wanting to see what the market can bear, the broker knows what the market can bear, and they know if that pricing is real or not. Yeah. And we don't want to waste your time there. So that would be a new thing that I would add. But then also underwrite the deals based on the criteria that you're comfortable with. And every firm has different criteria, whether it's cash on cash, 10-year IRR levered, or cash, whatever. And then also you need to get a quote from your preferred lender day one of underwriting, because what you thought, when we've gone to market, when we go to market, most of the people that are interested right now are still active players. So they do know where rates are. They're checking the 10-year daily. They're talking to mortgage brokers regularly. Those types of people know where the market is at, know what they can get. What you can get, Todd, is much different than what someone that buys $2 million properties can get in a rate. You can get a stronger one because you have a longer history. You've got more properties that are under your management and ownership. So your rate is different than the next person. And the next person is kind of hearing rates online. Anyway, get your rate based on what you can do. And then underwrite the deal based on what your underwriting criteria is, and then make an offer, because there are less buyers in the market right now. The people who are sitting on their hands, they're going to miss deals. The market is down. There's no question. In the Twin Cities, it was 20 to 30%. We're definitely 30% down. There's no question anymore. If it's 20 or 30, it's 30. And anyone who's telling you something else, they're trying to sell you.
Yep.
And I'm trying to sell you too. So, I mean, it's just to know that this is where the market is at. And this is the Twin Cities. This is a stable market. So if you're in another market that's really unstable, whether it's, I won't name out markets in a negative way, but other places that have had huge 20% rent growth, well, now they're having not that rent growth.
Right.
Their values are likely more than 30% down.
Yeah. Yeah, it's interesting times. I think it's really important what you just said. Like, if you're an active buyer, you value your time, just talk to the broker. Is this seller committed to selling? Like, that's a question that you can ask any broker. Is this seller committed to selling at whatever price the market bears out?
Yeah.
And if the answer is, well, they need to get, their price, then it might not be worth underwriting, or at least taking a very deep underwriting look at it. Right. So especially if they listed it or had listed it a year prior, and it was, maybe it didn't sell at that point in time for 20 million, and now they still want 20 million. Well, sorry, it's just not gonna happen today. So I think if that seller is committed to selling at whatever price the market bears out, then yeah, underwrite that deal. But we've looked at some deals, and I'm thinking of one in particular, and it was the seller just was fishing.
Mhm.
And it's frustrating when you go in and you're like, look, this is what it's worth. Like we can show you right here. And it's like, well, no, they need to get this price. And then 4 months later, they're still showing you this deal. And it's like, there's no reality here, guys. Well, why?
Yeah.
We're not going to look at this deal again because the seller is just trying to fish and get some sucker to buy their deal. Like that's just not worth your time. So let's talk about rents. What is happening in, Twin Cities and maybe outstate market? What's happening with rents overall, and what are you seeing that's maybe strong and weak? I mean, you've mentioned a little bit of it, but
yeah. So just to get the two places that aren't having rent growth out of the way, St. Paul, because they put a cap on it, on rent growth and rent control. Minneapolis, some areas like Uptown having negative rent growth. Some other neighborhoods too, but Uptown in particular. Now the North Loop in Minneapolis having tremendous rent growth. So very dynamic markets, very dynamic cities, just like a lot of metropolitan MSAs across the country. But let's just take those two out of the conversation for now, focusing on the suburbs of the Twin Cities. We are having, what's the stat? 5.4% rent growth in the suburbs. And that is of the people that are raising rents. Now, a lot of these mon pa, so Twin Cities is mostly a private market. I think we're 80+% private.
Yeah.
These family ownerships, they don't raise rents really. They don't even raise 3% sometimes. They might raise $20. Well, $20 on $1,000 is not equatable even to inflation. So those rents are really, really low. And to kind of use an example of this, so we sold a property in a suburb, Champlin, that has had limited new development, and we sold a property. We underwrote a value add deal for $200 to $300 in that market with a post value add. That client has been able to raise all of the rents post value add $400 plus, and most of the residents moved from an unrenovated unit to a renovated unit that was $400 more a month, no question.
Yeah, which shows you how strong that case is, right? Because they know where else are they going to go, right? If they're seeing it, they're looking. I guarantee those residents didn't just roll over. They looked around. They went, well, where else are we going to go? Like
exactly. And that's a great case. So the rent growth that's being, when you get these stats, this is only the major properties that are showcasing the stats. And I would argue that we've had an influx of development, which is a good thing in the Twin Cities suburbs. We had 13,000 units come online in the Twin Cities this year. Most of it's in the suburbs, about 50%, or there's like double the development in the suburbs. And so that's a lot of units going online. And because of that, there has been more concessions given, especially to new developments and the competition for new developments. And then the rent growth has been stagnated a bit just because there's a ton more units online, simple supply and demand.
Yep.
Well, next year we have half of that, 5,000-6,000 units coming online. And so all of a sudden, all of these new deliveries get absorbed into the market. There is a lot less competition for new deliveries. That less competition is not just next year, it's the following year. With interest rates so high, it's just burdensome to build new market rate properties. And so with all of that in mind, I think we're going to see much higher than 5.5% rent growth once all of this gets absorbed.
Yeah. So we might have a little bit of a lag here. Maybe it's 6 months or so, but you have a little bit of a lag and then it picks right back up. And I would tend to agree with you. And I think what you've just mentioned here, what we just talked about, is really important for anybody to listen to understand. you talked about two markets, St. Paul and Minneapolis, that are seeing declining rents or very little rent growth, maybe some submarkets. And even that is to my point, like some submarkets are growing, but the suburbs are growing. And my guess is all suburbs aren't the exact same. I'm sure we could take Woodbury and all the Edina, and they're all different, right? It's really important if you are a buyer to understand where you're buying. And so just because you go, oh, look at the Twin Cities, rent growth there is 1%. That's whatever. And well, wait a second though. You took the entire market and just made an assumption on that entire market. You didn't look at what is actually happening and going on there. And then you didn't take into consideration the deliveries currently and the deliveries in the future and what is truly happening overall in those markets and submarkets. Where do people want to be? What the real rent growth is. So dive deeper. Don't just look at these. I hate state statistics. Like people are like, what's the best state for rent growth? Who cares? Like, I don't care what the best state is for rent growth. What's that have to do with anything? Like, that's just like saying what's the rent growth in the country? I don't care. I'm not investing in the country, right? Mm-hmm. I'm investing in a specific submarket in that, location. It's got its own statistics. I think that's super important.
Yeah, definitely. And Todd, just kind of, I've been thinking about your team in Duras and then Minnesota, and I know your team has gone outside for other reasons besides just not having a ton of deal flow here. But something to note, just like you said about rent growth, some of those other markets, let's just use Columbus, they're really expanding and growing in a big way, and money is flooding there. And so now your buyer pool is way more competitive. Now, in Minnesota, our buyer pool has declined. And so you're able to win deals that you might be getting the same amount of returns on in other markets just because your competition is also chasing those deals and they're drawing up the price there. Yeah. And so I'm not trying to poo-poo any other markets. I'm just saying that a market like the Twin Cities where you have less competition is another great place to invest because there's less people bidding up deals.
Yeah. And obviously as a seller, it's great when you've got a lot of people bidding up deals, but as a buyer, if you're looking for opportunity, that's a fantastic thing. Less competition, the better. As speaking of buyer, and we talked about the broker, let's talk about quickly, like what does a buyer need to do today in today's market to get a deal under contract? Yeah.
Definitely talk to your mortgage broker, figure out what your rate is. But so we kind of talked about those mechanics, the science of the deal, but let's talk about kind of the art of the deal. And something that a buyer can do is, so most of the deals that a seller is truly selling, they are on market with a broker. So get to know your local brokers. Here in the Twin Cities, there's, I'm just going to say 5, maybe 6, you could say, major brokerages that really control the 50 plus units for sale here.
Yep. And they're not putting you in their car to drive you to other brokers' deals, just so you know.
Exactly. Yeah, exactly. So when a broker, so for example, when there's a deal, whoever the broker is, if you like a deal with me or another person, if you're wanting to buy that deal, call them or email them, ask them about who the seller is, and if it fits your underwriting, tour an offer, because you don't know who you're going up against. You don't know if your competition is really aggressive or really conservative in the underwriting, and your metrics might be different than the next buyer's metrics. You don't know, you might win that deal. There are some institutional deals that have recently traded here. Right now, institutions are selling for liquidity. They're wanting to get out of some places, locations, properties that aren't performing as well, and they're wanting to take that money and they're wanting to buy because they're seeing this is an opportunity to buy. So they're selling to be liquid. They're selling based on what the market's going to do. They're a huge fund. They're just doing what they do. So some of those properties offer, once again, you don't know where you're going to land. You might win. And another thing about offering on properties with realistic, like offer on properties that you can actually execute, not just make offers, of course.
Right.
But that broker.
What about making the quote unquote lowball offer? And I'm not saying just a lowball offer, just to throw something that's ridiculous, right? But we underwrite a deal. We go, this is where we need to buy it at. We just do. Like, this is, for us, it's 16 million, but the whisper price is 19 million or something like that. Like, that's a kind of a lowball offer. Would you just say pass on that deal, or is now, because I would have said, 2 years ago, but don't even waste your time on that deal. But is it something that you would waste your time on now, or still kind of pass on something like that?
Call your broker, figure out what the seller, if the seller is a real seller in this market, a market seller. That's kind of our term right now. A market seller is selling in the market no matter what the market bears. And so call the broker, ask the broker if it would be valuable to submit your offer. The broker controls the deal. They know what's going on in the marketplace. They know their seller too. And to just keep your relationship strong with your broker, who's likely going to also get you other deals, whether it's this one or the next one, call them, ask for a seller, why the seller is selling. Are they a market seller? If that's been established, great. Say, I'm coming in at 16. I recognize your pricing is 19. Is this something that we should offer on? Can I get your take on that? And the broker may say, your underwriting is meeting other similar buyers. I would offer this seller is a market seller. Or they're going to say, that might not be an offer. The seller is not interested in that offer. Please don't offer this time. If the seller changes, the broker can tell you. That's kind of a strong broker, which if you're dealing with a major property, the broker you're dealing with is likely strong, or the broker team, and ask them.
Yeah. Love that. What else? I'm sure you pulled up some other statistics or maybe talking points you really want to hit on it. I do want to be respectful of your time, but anything else that you think is valuable for our listeners to know?
Yes. So, the other thing too is in markets like the Twin Cities, we talked about rent growth and we talked about wage growth, but then there's also expense growth.
Yeah.
And one other thing that I'm suggesting to sellers, so now kind of focusing on a seller, but then it's also an opportunity for a buyer. The taxes in everywhere, but especially Minnesota, they're pretty high. And right now, when I'm underwriting a deal in St. Paul, 9 out of 10 times, their tax assessed value is more than the value that the market would bear for their property. And so I've gotten a lot of people in touch with real estate attorneys who can fight that for you. Yep. And I'm talking usually they're paying $20,000 more a month than they should because their assessed value is so inflated. And so for a seller, if you have a little bit of time before you're planning to sell, I would fight those taxes. 20,000 added to your NOI, capitalize that at whatever cap you want. It's huge. Yep. And unfortunately, you do have to likely go through an attorney. Assessors are not easily reassessing properties for less. That's not good for a city, but that is where the market is at. On the flip,
paying the attorney will pay for itself so quickly if you have a case, and the attorney's not going to mess around if you've got no justification to. So they'll give you at least a good one. It's going to give you advice like, hey, this isn't worth it, or this is. We just did this to a bunch of our properties, and we got huge tax reductions in some cases, some not so much, but I mean, we got some nice reductions. So it's definitely worth it.
Yes. And a broker, we're actually underwriting a reduction in the buyer's future taxes, because the moment a property sells, you don't even have to get an attorney involved. There's no argument. The property sold for this, it should be assessed at this. Yep. And so that is really benefiting buyers in a lot of ways if they're willing to look at that. Now, lenders are not as open to that all the time, but that is a true case. You buy a property at a price, the assessed value meets that price. You don't overassess it if you just bought it. So I would check your taxes. That's a huge expense increase that you really, like 2 years ago, you can't fight the tax man. Today, you can fight the tax man.
Yeah. And make sure you do, because they're I guarantee the county's not going to do it for you.
Oh, they are not. They are not, for
Yeah.
sure.
The other big one we've had just with insurance is talking with your insurance broker upon renewals and saying, hey, what else can we do? You know, I would hesitate to drop your coverage down to a lesser coverage unless you've got too much coverage. But you might be able to get some nice quotes and potentially some reductions, or at least not quite as big of an increase. So we've seen some properties where you're like 15-20% increase, and then you go get another quote and it's like, oh, okay, now we're only paying 7%.
Yeah. The other one that I kind of want to touch on that I think is interesting that doesn't get talked about a lot is payroll, which we know has gone up. But two kind of notes about this. So client of ours, national client based outside of Minnesota, but active in this market, they have shared that the payroll in the Twin Cities and in Minnesota is way more than other places in the country. And that goes to our wage inflation here. We've got really educated workforce. We've got really, really high paying jobs, and people in this community are taxed heavily. They expect a lot, and wages is something they expect. And so our payroll is really huge. And I want to kind of share something a little controversial perhaps, but a client of mine is really focused on their operations right now because it's hard to buy a deal and they need to shore up their expenses. Their expenses are getting 60% of the deal. Well, that deal is not cash flowing the way that it used to. Right. And so they've lightened their payroll load in the way of virtual assistants, assisting property managers. And so here's the controversial part is the property manager needs to be someone that is on site. It is always better to show a property in person to get that quick lease sign up with an in-person. A virtual tour is great for a first look, but to get that client to sign that lease, you need a person. Yeah. So that cannot be done virtually. However, answering the phones for maintenance, answering the phones for questions, that can all be outsourced on Upwork to someone like a client of mine uses 8 virtual assistants in the Philippines for less than $10 an hour for each person. Yep. And so these types of jobs that are really hard to source. So in the Twin Cities, to get someone to just answer the phones, it would be really hard for you to find a person truly. So I'm not, trying to promote getting people outside of our country to do these jobs. I'm just honestly saying it's hard to hire people here and hard for kind of a little bit of a lower skill type of job. And so that's something kind of interesting that a client of ours did. He restructured and he minimized some of his on-site people that were doing a little bit less challenging jobs like answering phones. And he outsourced all of that. He also outsourced all of his scheduling, all of his, he will ask his virtual assistants to call 8 insurance brokers, get quotes, come with a memo on all of them. And then my client will go and engage with a few of the top ones. So he's getting some of the best people to do lawn care at the best rates. So like reliable people at the best rates. And he's not having to spend his time to do it, but he is outsourcing these more menial tasks to someone else who's happy to do it.
I love that. And I get what you're saying with the hesitation of it, but I love it. And I think it's necessary a lot of times. And like you said, like there's just answering phones, scheduling, like stuff like that. I'm sorry, but I'm not going to pay somebody $30 an hour to do that. Right. We can go and we can hire somebody else and it frees up other people's time to do more important tasks. Yeah. There's certain things we can't replace. We can't replace a face-to-face contact. But if somebody's just calling on the phone, quite frankly, and here's the other thing, like if you've got virtual assistants and you've got enough of them, they can answer the phone 24/7. So It doesn't matter when the phone rings. The office is only open from 9 to 5. Yeah. But if somebody calls, and most people do after 5, we can still answer that phone. We can get them scheduled. We can get the showing. Now they can show up and we can actually be successful at closing that deal with the person that's on site. So I think that's huge, is finding different ways to cut your expenses. Technology is another way. I mean, we're always trying to figure out, is there a better tool out there for us to be able to achieve better results and cheaper results.
Yeah. Mm-hmm.
Love it. Anything else that we missed? I'm sure there's all kinds of stuff, but
yeah, I think that covers a lot of things right now. Appreciate you having me on.
Yeah, well, I appreciate it. It's just nice to get a opinion, or just kind of what a broker is really seeing in the market. Because as a buyer, as a seller, we are in a totally different role, and you're seeing what's going on with a lot of different operators. You're seeing what's happening real time in the market. Your job is to, as you said, kind of consult between the two, understand the markets, understand the trends and where things are going, and rely on those broker experts if you're sitting here as a buyer or seller, and understand what you need to do to market your property, to make it better, to get it ready for sale, and understand the market and what's going on, and how to stand out as a buyer as well. So Heidi, really appreciate it. And what's the best way for our listeners to reach out to you?
Yeah, reach out to me on LinkedIn. I'm really like the only Heidi Addo out there. So reach out to me on LinkedIn. Love to connect. And yeah, appreciate your time.
Awesome. Thank you, Heidi. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience, and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially, and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.